Welcome to Real Estate Syndicate Live. I am your host, Mauricio Rauld. The SEC just released their report on the accredited investor definition that gives us a window into what they might be thinking in terms of an update. To be honest with you, it looks a lot like the content I've been putting out over the last 18 months. And so in this episode, we talk about what exactly the SEC is looking at, specifically when it comes to the accredited investor definition adjusted for inflation. We also look at the IRA issues that they bring up in their report, showing that their IRAs may be artificially increasing people's net worth. And then we also look at some of the recommendations that the SEC subcommittees have been making about what they should do moving forward. This week on Real Estate Syndicator Live. Well, welcome. This is cool. I was trying to figure out on Friday what we should be talking about today because it was a solo. I didn't have a guest scheduled. And lo and behold, the SEC came out with their accredited investor report and people were sending it to me. And I'm like, well, why don't we just talk about it on our live? So I spent the weekend taking a look at it. It's not super long and not, they write these reports in plain English. It's not that difficult to read. It's not like it's a bunch of legal stuff. It's actually, I think, I know it's written by the staff. So it's kind of written in plain English. But anyway, so that was cool. It showed some movement on what we've been talking about. And in fact, I think it's kind of, if you read the report, it's like the SEC has been watching my content. They basically repeated a lot of stuff that I've been saying that I think was going to happen. So as a reminder, and I think this is why it just came out under the wire in December, the SEC has a mandate to update or review, not update, but to review the accredited investor definition and all that stuff every 4 years. So literally every 4 years, I've got to take a look at it. And, every so often they'll look at it and then they'll do an update. So the last time they, 4 years ago was 2019. 2019 was the last one it did. And that actually led to the updates of 2020. So if you guys remember 2020, there was kind of the expansion of the definition, including registered investment advisors, Series 65, Series 7, Series 82, knowledgeable employees. So they keep updating it. And it all starts with this report. So every 4 years, they take a look at it. They gather all the data from the last 4 years and boom, they come up with this report. And then that report, I'm guessing on this one, but that report then is used by the committee to actually figure out whether they want to make any updates or not. And so I expect this to be the first of many steps, and the next step being a proposed rule. That's going to be the next step, is a proposed rule to propose whatever updates and changes that they're planning on doing. And just as a reminder, it's like for some context, this all started in 1982. So what is that, 40 odd years ago, 41 years ago. That's when they came out with 506B and Reg D and accredited investor. And then along the way, they've added to it, right? So I looked in 1988, I guess, is when they added the 300,000 thing. So it used to just be $200,000 for every individual. They didn't have a situation for you and your spouse. And then in 1988, they updated that to include the spouse. And then in 2011, they updated it to include or exclude somebody's primary residence. If you guys remember that was because everybody in California, I keep joking, was an accredited investor because property values were going through the roof in 05, 06, 07, 08, that they updated the definition to exclude primary residence. And then in 2020 is the addition, the latest updates we get. So every 4 years or so, I know every 4 years they do this report and then they update the thing. And so what I figured I'd talk about today is I came away with basically 3 takeaways. And again, the whole thing's 50 pages. I think if you just read through it, it'll probably take you 45 minutes if you're interested. And I think I don't know if I posted it. I'll post it in the community if I haven't, so you guys get a link to it. Or you can just Google SEC press release and they'll have a little blurb and then they'll actually have the report. But I kind of came away with sort of 3 takeaways from the report. There's a lot more than that, but these are kind of my top 3 things that I came away with when I reviewed it. So the first one is that they focused heavily on the difference between how many people were accredited back in 1982 versus how many people are accredited today. And they threw out a bunch of statistics, but I thought was interesting is they came up with the same analysis I've kind of been talking about over the last 18 months, which is like, hey, if you just take if you just take the number, let me say that again. If you just take the $1 million net worth limit in 1982, if you adjust that for inflation using CPI, which, you could argue that has its issues, you're at $3,037,840. So that's something that they've explained that, hey, we haven't been adjusting it for inflation. And so if you just take 1982 numbers, you're at just basically just over 3 million. They then focused a lot on, and they had a lot of stats, and they acknowledged the stats weren't exactly perfect, but they went through and said, look, in 1983, right, so the year after it started, 1.8% of households were accredited. And they only have statistics for households. So technically you could argue individuals might be a little bit more. So they only have data available for households. So this is all based on households. But in 1983, the first year it was implemented, only 1.8% of households were accredited. And then they jumped to 1989, and that number jumps to 3% of households were accredited, had accredited investors. And today, or at least last year in 2022, that number went up to 18.5%. So since this has come out, we started with only a 1.8% of households were accredited to today, it's 18.5. And what I thought was interesting, which again, kind of, I think gives you a little window of what they're thinking. They then projected it out. So they said, if this continues in 2032, there'll be 31.4% of households will be accredited. In 2042, it'll be 49%. And in 2052, 66% of households will be accredited. So this is obviously something that's on their radar, and they understand that this is not a trend that can continue. And to be honest with you, as I was reading this, it's a lot of the stuff that I've been talking about, which is, hey, they want to update the definition. And it sounds like this is one of the things they're going to be looking at, which is the adjusted for inflation's numbers. Some people are arguing that it should just be adjusted moving forward. So just start today with $1 million, tomorrow $1.05 million, then the next year $1.01 million. But honestly, with all the statistics, I do think they're going to go back and make some kind of an adjustment based on inflation going back. So that was the first thing that I thought was super interesting. The second thing I thought was interesting is that they focused a lot on IRAs, which came out of the blues for me. So they focused a ton on IRA, meaning back in 1982, when this thing started, a very small percentage of retirement funds were in IRAs. I guess back then, a lot of it was sort of the pensions and defined contributions as opposed to what it is today. And again, they threw out a bunch of statistics where today, 34% of people's retirement accounts are in IRAs versus back in 1982, that number was 2.5%. So a huge increase in the amount of people's retirement accounts in IRAs. And they did the calculation as to, hey, if we eliminated the IRA money as an asset, if we stop counting IRA money as an asset, then the accredited investor pool will shrink from about 12%, 12.5% to be exact, today to 8.8%. So the pool of accredited investors would shrink if they took away the IRA money, which I actually had never thought about, but that's definitely one thing they're looking at. It might be something they incorporate in addition to, or in lieu of the increasing the dollar amount, just looking at the IRA money and just not using that as the calculations. That's going to reduce at least somewhat the accredited investor pool. So that's another lever that they could be looking at. I've been really focusing on the net worth number, but this is another lever. By the way, on the net worth, somebody always asks me, have you heard anything about income, right? If the income number is going to go up. And they did go through the numbers on what the income was, $200,000 adjusted for inflation. That was $607,000 today for a single person, and about $911,000 for couples. So I can't see a world where they're going to jack the numbers up that big. Because I mean, if you're in the $600,000 range, you are top 0.5% or 0.3% of income. So that seems a little high. But again, that's something I thought was interesting. And then the last thing that I thought was interesting is that they do go towards the end, they go to a bunch of suggestions. Like a lot of commentators like myself, I'm considered a commentator. You guys, anybody who's in the market can always write to the SEC and say what your thoughts are on what you want to do. And so they went through a bunch of those, but the ones I thought was interesting was there's actually a couple of subcommittees of the SEC, which is the Small Business Advisory Committee. They came out in 2019 saying that they should leave the definition the same, but maybe just adjust it for inflation moving forward. That was one of the recommendations. And also one of the recommendations was, hey, maybe we do eliminate the IRA money. We don't count the IRA money because that's going to shrink. And then there's another movement. I think I was, sorry, I lost my train here on, there was the other, anyway, there's a couple of others. I escaped what it was, but there's other people that wanted to suggest other things, and it's literally a combination. At the end of the day, it was a combination between adjusting for inflation starting in 1982 to today, adjusting for inflation only moving forward, adjusting both, meaning adjusting it from 1982 and then moving forward, adjusting it, taking the IRA money. And then the other thing that I thought was interesting, which actually makes a ton of sense, was one of the SEC, this is what I was looking for, one of the SEC subcommittees also suggested that maybe the accredited investor thresholds change by geography, right? Because obviously if you make $200,000 in California versus making $200,000 in, Nebraska, not to pick on those two, but you know what I'm saying? Like that is a huge difference. And if you figure out what percentage in relation to everybody else in the state you are. So that's another thing they're looking at, of maybe tweaking it, or at least some of the recommendations have come on is tweaking it based on geography. And there's other factors they throw in, just, underrepresented minorities, and there's a bunch of other things. But I thought those were the interesting ones. So I guess I need to think of it in my own content in terms of, is it just going to be an adjustment based on income and net worth? Or maybe they do figure out, hey, maybe they pull the lever of IRA, or maybe they pull the lever on geographic location, which is something that one actually makes a ton of sense to me. So, but at the end of the day, here's the issue that they're facing. They came out with a bunch of statistics. If you guys are statistic geeks like I am sometimes, they've got a bunch of tables, how many offerings, have been made over the last 20 years, or how many offerings were done last year, how many accredited investors, what's the total amount of raises. I mean, all these statistics are there. But at the end of the day, the one that stuck out the most was from 2009 till today, or 22 till 2022, there's been about $10 million investors that have invested in Reg D offerings. 99.7% of them are accredited or have been accredited. Now, I know in our world, we deal with a lot of non-accrediteds. Even in our practice, I would say probably 70% are still non-accredited investors and 30% is accrediteds only. But if you look at the broader market, the bigger market, the vast majority, 99% plus of investors are accredited, which means when they come out with these regulations to protect the little guy, to protect the person who's not accredited, it's a really small percentage of people that they are actually now affecting, right? And again, if you go back to 1982, that number was much bigger. They wrote these rules to protect those, theoretically, the little gal who can't fend for themselves. And so that's, I think, the reason why all this stuff is coming out. They want to increase the amount of people that they have the ability to reach and protect, because right now we're looking at 0.3%. So anyway, we'll continue to monitor the situation. I still think that the next move is, again, we don't know when, but that a proposed rule will pop up, just like it's going to happen like it did on Friday. Friday, we're all minding our own business, and suddenly, boom, you had a press release, and here it just got released. It's going to be the same thing with the proposed rule. At some point, there's going to be a much longer proposed rule. Proposed rules are usually 600 pages or so. This was only about 50 or 60 pages, so maybe 10 times the amount of pages. So they got to come up with a proposed rule. They got to draft that, but I think that's coming in 2024. Now that this thing has come out, and I still think they're going to do something to shrink the pool of accredited investors, whether that's increasing the number to 3 or maybe to 2, or maybe, hey, now it's maybe get rid of IRA plus do this. Whatever the levers they're going to pull, they want to shrink the pool of accredited investors. But remember, that's only to become an accredited investor automatically. I still believe, and in fact, it's true today, that you are going to go be able to take a test, right? So if you're not an accredited investor today, go take the test, become accredited. Or if you are an accredited investor, but somehow get eliminated from that list because of these new updates, you still have the backup, which is you can go take the test. So again, I'm sticking with my position that, fast forward a year from now or whenever, you're going to have two paths to become an accredited. Either you automatically qualify financially, or if you don't, you can go take a test and qualify from a sophistication standpoint, or accreditation standpoint, certification standpoint, I should say. That's what I got. If you guys have questions, just maybe raise, do you guys know how to raise? Go to the reaction tab at the bottom and just raise your hand, or if there's not too many people raising their hands. If you've got a question about the accredited investor stuff, that would be awesome first. And then after that, we'll open it up to Q&A on whatever's on your mind and anything you think I can answer, including what's the best red wine on the market today. William.
Hey, thanks, Mauricio. I haven't read the SEC document, but I did read a couple other articles from the talking heads, and one had discussed that perhaps in qualified retirement plans, limiting the amount that could be invested in private placements, like for example, make it 10%. And if it's more than 10%, then maybe revoke the tax qualified status of the IRA. Is there any discussion of that in the document, or is that just something that they're kind of theorizing
No,
about?
there is a 10% discussion, but not in that context. So I did see that, which I didn't bring up. But I mean, there was literally, 15 or 20 points I could have brought up. But one of the points was in there, and I'm going off memory, but that, it was how much of your net worth you were investing in. So if you limited, and you can go either way with this, but basically saying, look, if you invest less than 10% of your net worth or income into the investment, then something can happen. So if you invest less than 10%, maybe you don't have to be accredited, or it's much looser because you're only putting in 10%. So it's not the end of the world. And so if it's more than 10%, then that's where we want to get more stricted. So that was another thing that was mentioned in the document as kind of a cutoff, which I guess is somewhat similar to, I think, what maybe that's where this article came out. Bloomberg came out with that article that said 10x accredited investor, but it really was people who were, who were investing 10x the amount of, basically investing $10 million. This specifically was 10% of your income and net worth. So that could be another threshold that could use it. But I didn't listen, to be honest with you. I didn't listen to any of the talking heads. So I don't know what they're saying. Maybe I should go look at that now. But, this came out Friday. I looked at it over the weekend. But there wasn't anything specific about making it ineligible for the tax exempt part. It was just another qualification. If this, then that. If you invest less than 10%, then maybe we can relax the accredited investment, because the idea is you need less protection, right? If you're only putting in 8% of your net worth and you end up losing it all, it's less of a concern than if you're putting in 80% of your net worth. Now we want to protect you. That's kind of the theory. Stephen, great question, William. Thank you, Stephen.
Mine's not unaccredited, so I can hold off if you want to touch some.
Yeah, let me come back. Yeah, let me come back to you then, Stephen. Thanks. Hey, Adriana.
My question is only out of curiosity. Why is it that the government implementing the increase in the amount or whatever that is? Is that because of what happened in Houston, or it was just it's just out of curiosity? Why?
They've been talking about, I've been hearing this now for 18 months. So when everything was great, and it all started with that Bloomberg article. So I've been following it for 18 months, and then they keep putting it on the agenda, and actually it's on the agenda way before the Houston deal. So this has been it first popped up on the regular agenda for last year. Then it was supposed to be handled at the beginning of this year. Then it was supposed to be October of this year. And then obviously it's going to be in April of next year. But now they've come out with, with this report. So it's got nothing to do with that. Again, it's just, as I mentioned at the beginning, every 4 years, Congress actually mandates that the SEC take a look at the accredited investor stuff every 4 years. And they did it in 2019. So now they were due by 2023. And look what happened. 2 weeks before the deadline, they get this report in. So I don't think it's got anything related to that. I do think, and I think the fact that they talked about the projections, I do think they realize this is not a sustainable model. Like if they're, look, you got to put yourself in their shoes. They're regulators. They want to go and create more regulation to help the little guy and little girl, little gal, whether you think that's right or wrong, that's what their mandate is. And so if they're looking at this trend and more people are becoming accredited and their laws and regulations don't apply they do apply a little bit, but not, they really are applied to the non-accrediteds. And that's what all these rules and regulations are. And if that pool is shrinking and shrinking and shrinking, then they want to expand the pool of non-accredited so that more of their regulations can apply to more people. That's really what's going on. And I think they're going to do that. And that's been my thoughts.
Thank you. If you can send that red wine, I'll take the suggestion.
I've been drinking. We'll talk about it later. Rebecca.
Hi, Mauricio.
How you doing?
I'm doing wonderful, and thank you again for hosting this. Just have a quick question and wanted to kind of confirm the test you were talking about. Is that similar to the financial advisor Series 65, Series 7?
That's exactly what it is. So right now, as we sit today, there is a path to become an accredited investor if you're not one based on net worth and income. And that is to go get yourself a Series 65. Really, it's go to get yourself an investment advisory license by taking the Series 65 exam. There's actually 3 of them. There's a Series 7, Series 65, or Series 82. Any one of those 3, you can go take, pass the exam, become licensed in your state. And that's the tricky part. Become licensed in your state, and you're going to become accredited. No matter, you could be broke and you would be an accredited investor because you've taken the exam. Now, the reason we harp on Series 65 is because even though Series 7 and Series 82 are valid paths, in order to take those exams, you need to get a sponsor. You have to be sponsored by a broker dealer. which is, why, I mean, maybe it's possible, maybe your buddy is a broker dealer, but generally why would a broker sponsor you if you're not going to go get a license and go sell their products, right? So, so that's usually out of the door. Series 65, you don't need a sponsor. And so the way we're working on it, and we're almost there, but what we're suggesting is create your own investment advisory firm, which is kind of a pain for most. It's not super complicated, but it is a pain if you're not in the securities world or what have you. So create your own investment advisory firm. So your own LLC, get that registered. Then you get your Series 65 license and you hang it under your own investment advisory firm, right? No different than real estate. You have a real estate broker and you have a real estate agent. When the agent, you work with the agent, the commission doesn't get paid to the agent. It gets paid to the investment advisor, and then the investment advisor splits the commission there. Same thing. You just need to hang your license somewhere. Now, if you have a friend or you've got somebody else who's willing to take you on as an investment advisor, do that. Otherwise, you have to have a firm. And what we're doing, I'm not sure I talked about this publicly, but we're so close. What we're doing is, originally I wanted to have a course or something to show everybody how to get their own investment advisory company. And there's some companies out there will help you do it. They usually charge $5,000 or $6,000 to help you through that regulatory process to get investment advisory LLC licensed. And so then I realized, wait a minute, I've got literally hundreds of people who want to do this, and having hundreds of people setting up their investment advisory firms, first of all, seemed like a lot and seemed like a lot of free business for this company. And so I decided to hey, why don't we just create our own investment advisory firm? Let everybody hang their license under our investment advisory. There'll be a fee, of course. I mean, there's some risks and there's still compliance on our end, but there'll be a fee for not huge, but I think we're going to charge, I think it's going to be $100 a month or something. So you hang your license under it's not going to be a Premier Law Group thing, but our RIA license. So then the only thing you really have to do is go study for the exam, which we'll help you. Well, we won't help you. We'll get you a course, a Kaplan course, something so you help you study, and then go take the exam. I can't help you take the exam. You got to take the exam yourself. That I can't help you with. But if you pass the exam, you're going to have a license, a registered investment advisory waiting for you. So you can go hang your license. And then at that point, you're automatically become an investment advisor. You won't be able to do anything, right? We're not here to oh, now I can do a fund of funds and now I've got an investment advisory firm and I can go get paid. No. This is only for you to become an accredited investor. So there's going to be no activity that you're going to be able to do. But I think that's going to be a solution that we can help non-accredited investors become accredited, which in turn, the reason we're doing it is that in turn helps our clients, right? The sponsors, because the sponsors want more accredited investors. The sponsors are actually the more excited about this thing because, yeah, we've got non-accredited that kind of want to be here. But if a sponsor can then say, hey, if you want to invest in our deals, go take the Series 65 exam, hang your license, then that's the reason we're doing it. But you can do it today. And I know that was a long-winded answer, Rebecca, and I apologize. So that's what's in today. Now, there's a proposed rule that was 2 years ago that the SEC has that proposed a similar thing, but instead of having to do the investment advisory, it was just go take a test and get certified. That has not been finalized. That's a proposed rule, and it's tabled. It's not going anywhere for now. Like the current administration, Commissioner Geisler has no interest in passing that. So it's just sitting there. Will it come back eventually? I think maybe. And then separate from that, there's Congress who have now passed legislation in the House, same thing, to have an exam that you can go take that's going to be administered by FINRA so that when you pass that exam, you become accredited without the need to go hang your license somewhere. That has passed the House overwhelmingly, but it's not passed the Senate. In fact, it's been in the Senate committee since since June 2nd. We're in the banking committee, and it's just sitting there. And there's an odds maker, I think it's congress.gov or whatever. They give odds of the bill passing. It's at 30%. So there's a 30% chance that this bill will pass Congress, become law, so that you can then go take a test. Because I think ultimately that's what I think is going to happen, Rebecca. I don't know if we talked about this. I think you're going to have this, again, dual path, right? Either you qualify as an accredited investor automatically, and that's going to be harder, or you go take this test. And when I say go take this test, it's not the Series 65. It's this new certification where you just have to go take the test. You wouldn't have to get, an investment advisory license or a broker sponsoring you. That's something different. It'll just be a certification. Cool. Thanks, Rebecca. Great question. Any other questions on accredited? If not, I'm going to go to Steven. Let's go to Steven anyway, and then we'll come back if somebody else has a non-accredited. Go ahead, Steven.
Hey, Mauricio. So got a question as it relates to co-GP on real estate syndications. And I actually posted this in the Slack, but just it was a little bit urgent, so I wanted to join the call. But The question is in terms of like substantive participation. I want to be on the same page with the partners that I'm potentially going to be going into a partnership with on who's handling what. You know, one of the main needs they want to bring us on is that they've exhausted a lot of their investors. They want some help on the capital side. They just got done with like 2-3 raises, but just want to make sure we're keeping everything above board and to what level, we need to be involved, that it's not just capital to make it legit. So
yeah, you have to be substantially involved, whatever that means.
Yep.
Right. That's the problem. Right. So let's do a refresher, because I think this is always important. I'm going to keep talking about it until people get it. So the general rule is you cannot raise capital, whether you're a sponsor or not. So all of you guys that are syndicating and have, partners, you guys are all under this general rule that you cannot raise capital for your syndication LLC, right? Unless you have a broker-dealer license. That's a general rule. So we have to find an exemption to that rule. And the exemption is what everybody calls the issuer exemption, which it's a terrible name because it doesn't apply to the issuer. It applies actually to the GPs of the issuer, right? And the issuer is just think of it as a syndication LLC, right? You created your LLC, you're the GP, right? This applies to the GPs of the LLC, right? And so the exemption is, hey, if you are doing, basically, there's a bunch more, but basically these three things. Number one, you are not getting paid as a GP transaction-based compensation, meaning I'm going to raise this much money, I'm going to pay a percentage of that or contingent on that raise. So no transaction-based compensation, because that's the hallmark of broker-dealer. Number two, you have to be doing substantial duties, which we'll get to in a second. And then number three, your primary role in the syndication needs to be those substantial duties. So those are the three things we always look at. And so when it's just you and one other person and you put together your syndication group and it's just, you and your partner, and ideally you've done these all together, it's just you, maybe there's 3 of you or 2 of you in your syndication company, and you're going out there raising money, then you're going to fit into this issuer exemption because you're not getting paid transaction based. You're not getting paid to raise money. You're getting paid to do all the stuff a syndicator does, right? You're doing the due diligence on the marketplace. You're getting your team together. You're finding the properties. You're doing due diligence on the property. You're talking to lawyers. You're doing this. You're doing your underwriting, right? You're doing 1,000 things. No problem. That's how syndicators get around the need to become a broker-dealer. That's why none of the syndicators that you see have a broker-dealer license, because they rely on the issuer exemption. However, if you're suddenly get kind of brought in at the end and you're not really part of the group, you're not part of the syndication company, generally, it's not like you're a partner, and you get brought in, usually to your point, later into the deal, and based on these posts, it looks like, hey, they need people to they need you to go raise money. First of all, they can't. Right? They can't bring you in to raise money unless you have a broker-dealer license. And so what happens next is we try and squeeze that round, I guess it's only a round ball, but what is that? That round ball and the square peg, whatever that saying is, like, now we're trying to figure out how do we make this work, even though at the end of the day, what's really happening is you're getting brought in to raise capital. And so the way you need to structure it in order to even have a chance is, number one, don't get paid transaction-based. So don't be like, hey, if I bring in $1 million, you're going to give me this much of the GP. If I bring in half, don't tie it to that. In theory, you should have an LOI where if you end up failing and can't bring in a dime, you're still getting whatever the GP interest is, because you didn't get brought in to raise money. You got brought in to do other substantial duties. So you're getting paid primarily for the substantial duties. So if I say, hey, I think I can bring in $1 million, you're like, great, I'll give you 10% of the GP. Great. And then you end up not being able to raise anything. You should still get paid 10% of the GP, right? If you're doing it right. And I know that doesn't happen, but I'm just giving you the way it's supposed to be. And so no transaction-based compensation, substantial duties, which is very nebulous, right? So what does that mean? What they really want to see is, once the deal closes, once the money part is done, how involved are you? What substantial role are you in the deal once the deal's closed? Right? What kind of asset management are you involved in? Investor relations is always the gray area. We can talk about that in a second if you want. But, were you involved in finding the property and doing the due diligence on the market, or putting the team together, or talking to lawyers, or doing the underwriting, or, doing the due diligence on the property? Yes, raising a little bit of capital, but are you doing all these different things where you could argue, look, I did all of these different things, and yes, I raised some money, but my primary role was all these other things. That's what you're really trying to show, right? As long as you spend more than half of your time, because to me, primary means if I need to primarily spend my time on something, it means 50% or more. So as long as I can show that 50% or more of my time was spent doing the thing versus raising the capital, which again, if you're a real syndicator, No problem. I'm spending 90% of my time doing the thing and 10% of my time raising the money. I mean, think about it. It's a 5-year deal. You're spending money, you're raising money for like 3 or 4 weeks, and you're spending 5 years working on the deal. So how much work are you doing? How much time are you spending on the stuff? And the tough one is substantial duties. If you go, unfortunately, this is the issue, is that until something blows up, most of our rules come from what we call no action letters. All of the no action letters are focused on the transaction base. That's really what they really focus on. And so we just don't have much guidance on what is substantial duty. So I always say the more, the better. It's like, and I say it's a sliding scale. So the more money you bring in, the more duties you should be doing, right? And I always give the example, and this comes out actually from a good friend of mine. He used to bring in somebody to be an underwriter. He would underwrite markets, like markets that they don't have time to look at all the markets. So they would bring this person in and do all these underwriting on all these different markets. And if they found something that they liked, they would bring it into the main underwriter who would take a look at it, right? And this person had a W-2 job and basically worked nights and weekends to do this underwriting on stuff. And in exchange for that, they got paid 2% of the GP. No problem. I'm doing work and you want to pay me 2% of the GP? No problem. Now, if this person brings in a couple of his friends, it's like, oh, 50K, 100K, no problem, right? 2%. I brought in a couple of investors. I'm primarily doing my underwriting. But if that person starts bringing in 500K, $1 million, $2 million, 50% of the raise, then I'm going to expect to see more than just, I'm expecting more than just seeing underwriting on the weekends. Like, what else are you doing? Because if you're just underwriting on the weekends, and I'm expecting that to be worth about 2 or 3% of the GP, but you're getting paid 25% of the GP, and you're bringing in $2 million of that. Now that story just doesn't start to fit. So I did hear one thing, and this is, I almost feel like we're amongst friends. So one of my colleagues mentioned at some point that, and when I say colleagues, one of our friendly, not somebody in the firm, but one of the other securities attorneys had mentioned that the SEC had said something along the lines that being an investor relations alone wasn't enough, because that's the way that most people try and do it. Just doing investor relations, which technically is asset management, technically it's something you're doing after the fact, that wasn't enough. And the reason for that, I tried to find that source, I couldn't. So my guess is that was stated at one of these conferences. So what happens is people put on these conferences. We actually go to an MCLE one, ongoing education, every March in Scottsdale, and Sebastian Gomez is always there, right? So he represents the SEC, or doesn't represent, he's a staff member of the SEC, high-ranking SEC. He's like, hey, whatever I say here is my own opinion. It's not the opinion of the staff. It's not official. But people, a lot of the staff members are on these panels, and so it may have come out of their mouth during there. I can't find any record of it. But same thing with investor relations. It's like, well, what are you doing? Are you doing substantial investor relations? Or let me give you the worst case scenario. The worst case scenario that I see is, number one, there are 7 investor relations people. Okay, well, no, there should be 1, and because those investors belong to everyone. It's not like, oh, these are my investors, I'm going to do investor relations to those people. So you would have 1 investor relations. And then how much are you paying them? You can get an investor relations person pretty good for 60, 75 grand. Like if you're paying them $300,000 or then it's like, why would you pay this person $500,000 if you can get a really good investor relations person for $60, $70, $80,000, right? So what are they doing? Are they just forwarding emails and it's like, oh, here's the report and I send it out? Or are they preparing the reports, and every time there's an investor complaint or investor questions, they're fielding those questions, they're figuring it out, they're responding, they're getting on webinars? I've dealt with investor relations folks from our scaled syndicators. They run this whole show. Like that's who I communicate with, is the investor relations person. They're the one that works on the business plan. They're the one that reviews the PPM. They're the ones who actually hired me. They called 10 different attorneys and then finally hired me. So there's that level, which is a real, and that way you might be able to argue, okay, great. So that's really substantial duty. So it really just depends on the facts and circumstances. You probably heard us say that a lot, facts and circumstances. But anyway, that was a long rant, so I apologize. I don't know if that answered your question or not, Stephen.
Yeah, I mean, I think one thing I want to clarify is and I put it in the post on Slack, but if one partner is raising a substantial more capital than the other, and I think you had said in some prior videos that I was watching that you can't tie any of it to capital whatsoever. It's like if someone's raising 80% of the capital, I feel like they should be getting more of the pie.
Yeah, they should be lead sponsor at that point, right? They're lead sponsor, 80%, and again, facts and circumstances. Let me give you another example. Is this so if let me pick the two. So Stephen, William and I, since it's the three that I see across the board here. So Stephen, William, and I, we start a company, a syndication company, and we're together. We're a team. Like, Rebecca asked a question. She's part of REAP Equity. So like REAP is a team, right? And every deal that you're doing, it's the three of us. We do this deal. We do the next deal. Let's say this year we did 3 deals. We did those 3 deals, or maybe 6 deals. We all do 6 deals, but it's us, the nucleus, right? Contrast that with me doing 6 deals with 6 different sponsor groups, right? That's a completely different fact pattern, right? So it's like, you just got to look at all the fact patterns. The easiest way for me to do this is for you to say, for me to see, here's how it really worked. Here's how much money they're bringing in. This is what the percentage ownership is. These are their duties. And let me look at the entire picture. And then I could be like, yeah, I don't think that's substantial, but it's very nebulous. It'd just be kind of I'll say a best guess, because I mean, I know what the rules are, but it is very fact dependent heavy. But to your point, Stephen, I agree. If you're going to have somebody bring in 80% of the capital, it's like, what's their percentage?
Kind of split. They found the deal. They did the due diligence. You know what I mean? But if you're doing some of the asset management, construction management, it's like,
I think you can get paid for that too. It's like, if you want to pay me, if I found the deal, you can pay me an acquisition. Like, hey, I found the deal. Maybe I even did all the due diligence. Then, pay me for that. There's nothing wrong with that. But then the guy who's bringing in 80% of the money, like, what else is that person doing? And does that story add up at the end of the day? That's what I'm going to look at. I'm going to look at, does it add up? But the reality is, a regulator, it's so nebulous that you could almost anything you could argue. And if I was sitting as a regulator, represented an SEC or a state regulator, I could argue, hey, that's not substantial. And then we just have to argue back and forth. Well, here are the reasons why I think it is substantial versus not substantial. And you're just gonna have to argue it. And ultimately you would argue it in front of a jury or a trier of fact or a judge. But the ones I see aren't even close. Let's be honest. Like, the one that you got, again, I don't know what the details of yours, the vast majorities I see are just clearly, well, first of all, it doesn't help that they posted on social media asking, hey, I'm looking for capital raises, right? So that doesn't help you, right? But and then all the docs don't help you either. When you have, again, this is another point. I know I'm kind of scattered, so hopefully you guys are getting value from this, but spreadsheets, right? You have a spreadsheet, your underwriting spreadsheet kind of allocates, well, Andrew's going to get this much and 5%, you're going to get this much, Mauricio's, then there's going to be like an allocated percentage for capital raisers. Okay, well, that's problematic right there, right? And remember, the spreadsheet, they're not privileged. So if you ever got into an issue and the SEC opens up an audit and requests and subpoenas you for all these documents, that's not attorney-client protected at that point. You're going to have to give over all the emails that go back and forth, all the spreadsheets, everything. And obviously social media, it's all public. So, and honestly, even if it was private, they would just subpoena those posts. And they're going to see, hey, you had a spreadsheet that clearly says that Joey or this, that you've allocated 5% for quote unquote capital raising. So all those things go into the facts. If you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.